The smartest way to fund your business is through cash flow. And this has never been easier than it is today. Just set up what is called your MVP, your minimum viable product, and start selling it as fast as possible. Welcome to another Fireside Chat with Darren Hardy. In this session, I'm going to answer a few questions that I hear so often. Should I raise investor money? And what is the best way? And how much should I capitalize my business with at the beginning? How can I get an angel or a venture capitalist to pay attention to me? And what is the best way to pitch them? And where else can I find money for my business? Those sound like questions that you have or would like to know the right answer to? If so, then you'll be glad that you tuned in here. I just wish that someone had told me these things before I had to figure them out for myself, the hard way. Millions of dollars would have been saved, and in one instance, $1 billion would have been made if I only knew then what I will share with you now. Okay, let's get started. On the funding and finance questions, there are 3 buckets of investors to draw from: shrewd, dumb, and smart. Let's start with the shrewd bucket. In that bucket, there are 2 types of investors: venture capitalists, also known as VCs, and angel investors. These are the investors everyone thinks that they want, only to find out later that what they thought they really wanted, they really didn't want at all. But by then, it's too late, and the knife is twisting in your side. Understand, first of all, as soon as you take on outside investors, you have just sold your company. Not just the pieces of equity that you have sold, but you have made the final decision that this business will be sold. It will be a build and flip business, not one that you can create a lifestyle with or have become a legacy that you can pass on to your children or to your employees. The only reason why an investor makes an investment is to get it out with an ROI. And in a private company, the only way that happens is when there is what's called an event, a liquidation event. That means a merger or an acquisition. It has to be sold or merged or transferred to retrieve their ROI. Otherwise, it becomes the worst possible type of investment, what is called the walking dead. It might be walking and it may even be successful, but your investment is dead, locked up, as in worthless, until there is a liquidation event. So if you want a lifestyle or a legacy business, don't even consider investor money. Now, specifically, venture capitalists. It is incredibly unlikely that your business will be invested in by a venture capitalist. I'm not trying to be a Debbie Downer here. I'm only trying to save you tons of time, energy, frustration, and delusion. Understand the math probability problem that VCs are faced with. Maybe 1 out of 10 of their investments actually work out. The other 9 are horrible bloodletting losers. Thus, mathematically, they can only make bets on the most assured deals that have a minimum of a 30-to-1 ROI potential, so that the one blockbuster hit can pay for all the losers and still have them come out okay. They have to restrict their investments only to opportunities that they actually believe can be the next Facebook, Google, or Uber. The chances you have a VC viable deal has a rounding error of 0, just like your kid being the next Tiger Woods phenomenon. Is it possible? Well, sure, it's possible, but not probable. In actual mathematical probability, it rounds out to a 0% chance. But you could still spend all that time, energy believing in unicorns. Or you could save all that time and choose a smarter, more probable, and prudent path. Unless you have, and get this now, unless you have a veteran celebrity management team, proven business model, proven revenue, and proven scale growth with a defensible and patent-protected intellectual property and an early market advantage in a lucrative market, remember 30 times growth trajectory in a short window of time, and an already identified acquirer who's chomping at the bit to buy what you have, and Mark Andreessen is your poker buddy. If those stars are not perfectly lined up for you, don't even bother chasing this rainbow. It's a mirage. Best you strike that option off your list. Now, angel investors are just the same, only they come with less money and are bigger pitas, pains in the ass. I know because I was one and I lead a group of angel investors now. Their smaller money requires them to do more deals of smaller size, which means they invest in smaller, less proven ventures. So their success ratio is usually 1 out of about 20 to 30, not 1 out of 10. And this means that they also can only make investments where they can see a potential for a 30 times ROI in a relatively short period of time to pay for all their loser investments too. And angels are anything but. They are a devil to manage, keep happy, and off your back and up your butt. They are definitely not worth the effort. Stay away from them at all costs if you can. Now, next bucket is dumb money. They're called FFFs, friends, family, and fools. These are people who are not experienced, sophisticated, or smart investors. And investing in your startup is incredibly dumb and foolish for them. But they do it because they like and trust you. To bring these people in, you have to create an expensive PPM, private placement memorandum, do hundreds of dog and pony shows, call in lots of chips, blackmail a lot of friends, and generally be that guy or gal that people start to avoid at the grocery store and at the PTA meetings. Building and running a business is stressful enough. You have the weight of your employees, families' lives, your customers' lives, your vendor and suppliers' lives on your shoulders. The last thing you need is to additionally carry the stress, worry, anxiety, and financial future of your friends and family who foolishly invested in your business only because they trusted you. Just like you should never lend money to a friend unless you want to lose your friendship, you should never take investor money from a friend for the very same reason. Last, the final bucket, smart money. This is simply you taking and keeping control of your destiny by you betting on you and your business. This means funding your business from 1, cash or savings, or 2, from leverage, as in bank financing, which requires you to borrow against the equity of your more secure assets. Now, does that sound scary? Then maybe you are not ready to be an entrepreneur. And maybe your business idea isn't very good if you don't believe in it enough to invest your own money in it. Now, the smartest way to fund your business is through cash flow. And this has never been easier than it is today. A business that I started in 2000 cost $1.8 million to build and launch. I put in nearly $500,000 of my own cash money into it, and we raised the other $1.3 million from an angel investor group. I could start that same business today for less than $5,000 from the same product build and launch promotion. It is so fast, easy, and inexpensive to start a business today. Just set up what is called your MVP, your minimum viable product, and start selling it as fast as possible, which is why I explain in the eFastPass program that the most critical skill to ever master is sales. And I teach you how to do so inside the program. Without the mastery of that skill, forget about being an entrepreneur. Then from incoming cash flow off your sales, you can continue to scale the business, never having to dip into savings or take on the PITA of outside investors. Oh, what's that? I can almost hear you saying, yeah, but my business is a restaurant or a cupcake shop or a fitness facility. I have to have money to build it first. Well, how can you start selling it as a service first? Make some of your food for the local craft fair. Do catering from your home kitchen. Use the profits to go get a truck. Expand until you have enough surplus cash flow to open a restaurant on your own money. Same applies to your cupcakes and to your fitness training facility. See if anybody actually wants the dang thing that you want to build a business delivering. Make sure enough people are willing to pay good money for it, so much so that you develop a significant surplus to fund your eventual physical location. Get creative. That's another important skill of entrepreneurship and success. Figure it out. Don't let money stop you from changing your money situation. There are a million stories of people who just figured it out, started from nothing, and created great fortunes. You can too, if you really want to. Unfortunately, most people are more committed to their excuses than they are their dreams and ambition. They like to talk about the idea, but not actually do the gritty work of making it happen, whatever it takes. And finally, there is crowdsourcing, the Kickstarter route. That's not really raising money per se. It's really just pre-selling. It's another form of building off of cash flow. You're just creating an arrangement with your future customer to pay you now for a hamburger or whatever you're selling next Tuesday. And for your Kickstarter campaign to be successful, once again, it's going to come down to your selling skills, your ability to market your Kickstarter offer. So go get yourself the eFastPass program. Now, in regards to picking your finance bucket, shrewd, dumb, smart, it also comes down to your objective. If you want to build and flip business, and the critical success factor is how fast you can scale it before somebody else does, then you'll need to raise lots of money and fast. Good luck with that. If you want to build, grow, and enjoy the life and lifestyle your business can fund, then bootstrap it. Keep the hands of investors, friends and family, and fools out of the cookie jar. Bootstrap as long as you can, long enough until you can get bank financing or advance payment contracts from clients and save any of that equity for key employees. And finally, to answer the question of how to pitch a VC or an angel investor, and this should also discourage you from further going down this route. There are a half dozen tips. As someone who gets pitched constantly, I can tell you. Number one, it's who you know. Investors invest with people that they know and already trust, period. Like it or not, think that it's fair or not, it's just how it works. If you do not have an existing relationship with an angel or a VC, it is highly unlikely you're going to get angel or VC investment. You've heard all your life that relationships are the number one success asset, and that is a fact. It is built into our survival mechanisms as a tribe species. Not to sound like a broken record here, just trying to give you all the resources to help you here. But inside the eFastPass, in the sales section, I teach you how to create the relationships that you need that can eventually bridge you to the relationships of VCs, angels, or even better, to your dream clients, joint venture partners, key suppliers and vendors, etc. It will teach you how to get all the critical relationships that you will need to thrive in business as an entrepreneur or even as an intrapreneur. Number two, who you are. The track record, expertise, and proven success resume of the CEO, the owner, the founder, matters more than the business itself. Now, a close friend of mine is a very veteran and very successful venture capitalist, and he was telling me about this company that he was looking at, and he was very excited about it and its potential to be an industry game changer, as he called it. A couple of months later, I was talking with him and asked how that investment was doing. He said, we didn't invest in it. I asked, what? But you were so excited about it. What happened? He replied, I was excited about it, but we couldn't find the right CEO for it, so we passed. Remember, smart investors bet on the jockey, not the horse. Without the right jockey, the horse doesn't matter. You can argue that all you want inside your head, but experience proves that's how you bet on success. And number three, values. Does the business mission and the values align with the values and focus of the VC firm or angel investor? This is key. VCs and angel investors investing is already risky and hard for them. Another way that they try to mitigate risk is to specialize and focus. You need to find the right VC whose interest, focus, and values align with your business mission. Number four, do you have a massive and readily accessible, proven market? I've already talked about how your business has to prove a direct line of sight to a 30 times ROI for the investor. That means there needs to be a big enough market that you have proof that you can go get to, and you can get to it affordably, and you can get to it fast enough. And doing so will end up being more valuable to a really big acquirer than your actual revenue. Again, 99.9999% of business models don't fit that criteria. Number five, dominance. Can you prove that you can become and maintain the number one or number two position in your big, massive, and lucrative market space? In hyperscale business model markets, nobody makes money on being number three. This means that you have to have a patentable or protectable, defensible product and market position. You already know your obstacles and you know the few source codes to your success. And the timing of your product and business has to be perfect. Many great products and their companies failed because they were either too early or too late. And I know this firsthand. I had a photo and video sharing platform that was superior to YouTube, but 6 months too late. They achieved scale and became worth billions. I sold my platform for less than 7 figures. In real estate, the key success factor is location, location, location. In business, it's timing, timing, timing. And then number 6, it's called clean cap tables. This means there are no partner, no spouse or ex-spouse problems. You have to have a squeaky clean cap table of ownership, which is why you never want to do a friends and family round that will kill your angel or potential VC round, and quite possibly your bank financing potential as well. You also have to have your corporate setup done right, have no litigation, and prove that you have operated with complete financial controls and transparency, and you've shown proper risk, reward, use of capital. All those factors are important to the future acquirer, which is why it is also important to the VC. There's 30 years of hard-earned education and experience being rolled up into these few minutes that we're spending here together. I hope that it saves you decades of time, pain, and anguish traveling down the wrong roads, and immediately gets you focused on the financial path that is most relevant to your business model so that you can accelerate your progress and success.